It's November 2025, and Bitcoin's price action has been nothing short of wild. Volatility is the name of the game, and every day brings a new headline. The world is watching as the most famous cryptocurrency continues to defy expectations, swinging between euphoria and panic. One day, Bitcoin is flirting with $103,000, setting new records and fueling dreams of a decentralized financial revolution. The next, it's crashing hard, wiping out weeks of gains in mere hours, leaving traders and investors stunned. But is this just the usual market volatility we've come to expect from crypto, or is something more sinister at play behind the scenes? Some analysts are starting to ask tough questions. Many in the crypto world suspect these sharp drops aren't random at all. They're coordinated, the result of deliberate actions by powerful interests with deep pockets and hidden motives. In February 2025, Bitcoin plunged below $91,000, wiping out over $220 billion from the market in a single day. The scale of the loss was staggering, and the speed left even seasoned investors reeling. These aren't just normal corrections, they look like orchestrated events designed to shake out smaller investors, forcing them to sell in panic while larger players quietly accumulate more. Prominent voices like Samson Mao have called out what they see as manufactured price suppression, with Bitcoin repeatedly failing to break $100,000 despite strong demand and bullish sentiment. The question is, who benefits from keeping Bitcoin down? Is it institutional investors, governments, or perhaps even exchanges themselves? If powerful players can suppress the price, it challenges the very idea of Bitcoin as a decentralized free market asset. It raises doubts about whether the market is truly open and fair. The dream of financial sovereignty is at risk if a handful of entities can dictate the price, undermining the core promise of Bitcoin as a tool for individual empowerment. This isn't just about losing money, it's about whether Bitcoin can truly remain outside the control of governments and big banks, or if it's destined to be manipulated like any other asset. The real question now, who's suppressing Bitcoin, how are they doing it, and can they be stopped? Are we witnessing the growing pains of a new financial system, or the machinations of those threatened by its rise? The battle for Bitcoin's future is happening right now, in plain sight. The outcome will shape not just the price, but the very soul of the crypto revolution. Let's talk about the whales, those holding thousands of Bitcoin. These are the market giants, the silent movers whose decisions can send shockwaves through the entire crypto ecosystem. Their wallets are so massive that even a single transaction can make headlines and spark debates across trading forums. When they sell, it's not a ripple, it's a tsunami. And lately, they've been dumping in sync. This coordinated selling isn't just a coincidence, it's a calculated move that can overwhelm the market in a matter of hours. The problem isn't just selling, it's the timing. Whales are offloading when new demand is weak. They're choosing moments when buyers are scarce, making it even harder for the market to absorb the shock. Imagine draining a pool with a bucket while the hose is barely on. That's today's market. The inflow of new money is slow, while the outflow is relentless and heavy. Whales sell, prices drop, smaller investors panic and sell too, amplifying the crash. Fear spreads quickly, and what starts as a big player's move soon becomes a stampede for the exits. This creates a vicious cycle. Selling triggers more selling, and the price spirals down. Each wave of panic feeds the next, making recovery even harder. Data shows coins moving from long-term holders to exchanges, a classic sign of big players preparing to sell. These transfers are like warning signals, hinting at more turbulence ahead. It's not just Bitcoin, Ethereum and Solana are seeing the same trend. The entire crypto market is feeling the pressure as whales diversify their selling. The early adopters are cashing out, whether for profit or something more strategic. Some are locking in gains, while others may be repositioning for the next big move. The result? Sustained downward pressure that makes any rally short-lived. Even brief moments of optimism are quickly erased by another round of heavy selling. The whales' actions aren't just market moves, they're shaping the entire crypto landscape. Their influence extends far beyond price, affecting sentiment and strategy for everyone involved. Until new demand returns, this cycle is hard to break. The market remains in limbo, waiting for fresh energy to turn the tide. The whales are making waves, and everyone else is left treading water, hoping for calmer seas ahead, but bracing for whatever comes next. The other half of the equation is demand, an essential force that keeps any market alive and thriving. Or more accurately, the lack of it. When buyers disappear, the entire ecosystem feels the impact. Institutional buyers, once hailed as Bitcoin's saviors and the backbone of its price stability, are now pulling back in noticeable numbers. Spot Bitcoin ETFs launched with a bang, drawing headlines and optimism, but by early 2025, outflows signaled fading enthusiasm and a shift in sentiment. JP Morgan flagged weakening demand for Bitcoin and Ethereum futures, a red flag for the market that can't be ignored. Retail investors can move prices in the short term, but it's institutional money that sets the floor and provides lasting support. With big players on the sidelines, Bitcoin's support is crumbling and the cracks are starting to show. Why the retreat? Volatility, regulatory uncertainty, and underwhelming performance have all played a part in driving institutions away. Institutions are risk-averse. When the market sours or the outlook dims, they bail quickly to protect their capital. Their exit leaves Bitcoin exposed to whale-driven volatility, with fewer buyers to absorb the shocks. Ironically, the very institutions meant to stabilize Bitcoin are now contributing to its instability, amplifying the swings. The demand drought is real, and it's leaving Bitcoin high and dry with little relief in sight. Without fresh buyers stepping in, every sell-off hits harder, accelerating the downward spiral. The market is waiting for conviction, a spark to reignite demand, but right now, it's nowhere to be found, leaving uncertainty as the only constant. Enter the hedge funds with strategies that add even more pressure. Arthur Hayes spotlighted a popular play. Hedge funds go long on spot Bitcoin ETFs while shorting Bitcoin futures. When prices fall, the gap between spot and futures narrows, eroding profits. To stop losses, funds unwind their trades, dumping ETF shares and pushing prices down further. It's not illegal manipulation, but the effect is the same built-in selling pressure at the worst possible time. These complex strategies meant to attract institutional money now amplify downturns. Wall Street's entry was supposed to legitimize Bitcoin, but it's become a double-edged sword. The tools designed to mature the market are now being used to exploit its volatility. The result? More risk, more suppression, and a market that's harder to recover. Bitcoin is no longer just about buyers and sellers, it's a battleground for sophisticated financial engineering. And everyone pays the price. Beyond market forces, governments are clamping down on crypto. New regulations, tax rules, and threats of bans are creating a climate of fear. In the US, regulatory uncertainty is driving companies like Coinbase to relocate. This confusion keeps big money out and makes investors nervous. Macroeconomic moves, like new tariffs, trigger risk-off sentiment, hurting Bitcoin. Bitcoin's price now moves with traditional markets. When Wall Street stumbles, so does crypto. The regulatory squeeze doesn't need to be a ban, just enough FUD to cap Bitcoin's potential. The message crypto is risky, and that keeps prices in check. While regulators tighten the screws, traditional banks are building their own digital empires. Once dismissive, banks like JP Morgan now launch their own digital currencies, JPM Coin for example. These bank-issued tokens compete directly with stablecoins, offering a safe alternative. Citi and Standard Chartered are rolling out blockchain services, creating a parallel, centralized digital asset world. This isn't a direct attack, it's a strategy to siphon demand away from decentralized crypto. Banks pitch their tokens as compliant and reliable, undermining Bitcoin's appeal. The result? Two digital asset systems, one open and decentralized, the other closed and controlled by banks. As banks leverage their power, they threaten Bitcoin's adoption. Their quiet, sophisticated suppression could be more effective than any outright ban. The fight isn't just for market share, it's for the future of digital finance. To understand today's Bitcoin market, look to the dot-com bubble. Back then, hype drove tech stocks to absurd heights, then the crash wiped out fortunes. Now, early crypto insiders are selling into every rally, capping Bitcoin's price. This constant selling echoes the post-dot-com era, where insiders cashed out and recovery took years. Analyst Jordi Visser predicts Bitcoin's consolidation could last another year before a turnaround. The technology is different, but the psychology is the same. Fear replaces hype, and weak hands get washed out. The dot-com crash didn't kill the internet. It cleared the way for giants like Amazon. The question, can Bitcoin survive its own winter and emerge stronger? History warns the road ahead will be tough. The parallels are a sobering reminder: revolutionary tech faces brutal cycles before it matures. The $90,000 level is Bitcoin's last stand, a critical support zone. For months it's been the floor stopping deeper crashes. Now, the price is testing this line, and everyone's watching. A break below could trigger a cascade of sell orders, confirming the bear's control. The next stop? Possibly $70,000. Goblin Town, as Arthur Hayes warned. Technical signals like the death cross add to the bearish mood. If $90,000 holds, it could spark a new rally. If it breaks, it validates the suppression narrative and shatters confidence. This isn't just about charts, it's about sentiment and the future direction of the market. The fate of Bitcoin hangs on whether buyers can defend this line. Bitcoin stands at a crossroads. On one side, believers fighting for economic freedom. On the other, powerful forces suppressing its rise. Whales, hedge funds, and retreating institutions create internal weakness. Governments and banks add external pressure, pushing centralized alternatives. The question, can Bitcoin break free, or is perpetual control the new normal? Will it remain a tool for financial sovereignty, or become just another asset in Wall Street's casino? The outcome depends on renewed demand, continued innovation, and the community's resolve. Bitcoin's future, revolution or gilded cage, hangs in the balance. The battle is on, and the stakes couldn't be higher. The next chapter is unwritten.